In this video, we're going to take a look at the San Diego County real estate market update as of October 2025. We're going to take a look at local market dynamics, active inventory, recent sales. We'll talk about interest rates, talk about Fed funds rates and future cuts, and talk about affordability and some other things that are impacting the market. And by the way, I am planning on doing some more regular market updates like I have in the past. So if you're looking to keep in tune with what's going on in the San Diego and Southern California real estate markets, make sure to subscribe so you're the first to know about future market updates. All right, let's go ahead and get started. So right now what we're looking at is median sales price in San Diego County. Right now I have detached houses, townhomes, twin homes, row homes, and attached homes. So basically just single family dwellings, including condos. And we have a 1.7% year over year increase in median sales price. Now, if we look just at attached units, not detached single families, we're at 4.5%. And detached is actually down 2.2%. So that's interesting how attached is actually leading the charge when it comes to increasing prices and detached is actually lagging. Active inventory, we're up 29.1% year over year. And this is the amount of properties buyers have to choose from. There's a lot more properties on the market. And as you can see, with new listings are only up 5.4%. So most of this active inventory is actually properties that are taking longer to sell. They're sitting on the market for a lot longer and not so much just an inflow of a whole lot of new sellers. It's been a while since we've looked at the market and done these reports. In the past, we were looking at things like interest rate lock-in and the effect that's going to have in the future on home sales. And we can certainly see that a lot of homeowners, maybe would-be move-up buyers, have really just held on to their home and rate. Why in the world would you get rid of a low 2, 3, 4% interest rate and buy at today's rates, oftentimes doubling your payment for an extra bedroom and double the payment? Doesn't make a lot of sense. So it makes sense that we're seeing not so many new listings yet. If rates continue to come down, maybe we will see that shift. Pending sales, 5.4% appreciation year over year. So a modest uptick. And sold listings were up 4.7%, small increase year over year, nothing too crazy. Active market time, we're looking at 15.6% increase, 37 days on the market on average to before property goes into escrow and is sold. Typically, what's going to be the biggest driving factor when it comes to whether prices go up or down overall is going to be supply and demand, and therefore active listings compared with sold listings. So across San Diego County right now, we have about 3 months of inventory, just under 2.9 months of inventory. Historically speaking, 3 months, that's a balanced market in Southern California. If we start getting 4, 5, or 6 months, we start getting much more strongly into buyer market territory. When the market was really crazy, there were times in many pockets we saw less than 30 days of inventory. So basically 10 properties on the market, 10 properties sold in the last month. Those things go really fast and there's a lot of competition in that case. 3 months is fairly balanced. Now let's take a look at mortgage rates really quick, because this is one of the biggest driving factors also. And right now we are sitting right around 6.34% as of October 2nd. This changes daily. This is just an average across the U.S. And depending on the loan type, you might be mid upper sixes. If you're VA or FHA, you might even be in the fives still or low sixes. So we are definitely down from the peaks that we had, bigger scale than I wanted. We're definitely down from the peaks in 2023. We were almost at 8%, and we were putting around the just under 7% rate for the last 6 to 12 months. And we've seen a little bit of reprieve since the Fed has continued the rate cuts this summer. And it's nice to see us back in the low sixes. Is that enough to move the needle significantly in the market? We can still see the market's pretty cooled right now in San Diego. So this is not having a huge factor yet. The question is, at what level does it have to drop to before we really see a significant change? And many people are of the opinion if we can get in the fives consistently or the low fives, that we're going to see that real uptick in surge in buyer demand again. But of course, the question is, what's going to drive that cut? Is the Fed just going to bring it down just based on continued meeting of expectations of inflation coming down? or are they going to need some sort of economic warning signal that's going to say, hey, we need to cut rates? So that remains to be seen, but right now we are in the low sixes, which is progress. And talking about the expectation of whether the Fed's going to continue cutting rates or not. And I just want to be clear, we've talked about this numerous times in past videos. The Fed funds rate does not directly influence mortgage rates. It does have a trickle-down effect. Generally speaking, mortgage rates are going to track the 10-year Treasury yield. We'll take a look at that in a minute. But that said, if the Fed funds rate does not come down at all, and the expectation is that the Fed is going to keep rates high for the foreseeable future, that's going to have some impact on the mortgage rates in the long term. But ultimately, mortgage rates are going to track what investors anticipate is going to happen in the economy, and that's going to be reflected in the 10-year Treasury yield. Now, looking at this is investor odds for what the percentage chances are of Fed funds rate cuts in future meetings. This is looking at 29 October meeting of this year, and there's a 94.6% chance that the Fed's going to drop the Fed funds rate by another 25 to 50 basis points. Right now we're at 400 to 425 target funds rate, not 25 to 50, just 25. And the expectation is that they're going to cut it down to 375 to 400. At the following meeting in December, they're looking at an 84% chance that they're going to cut it an additional 25 basis points. And then in January, it's starting to get split here. You can see, okay, some think that we're going to continue down. Some think we're going to hold it there at 350 to 375. And some, there's even a chance being put that maybe the rate will come back up. And then you can see at the January meeting, there is even a chance being put that they're going to keep rates steady there, or they're not going to cut it further. Some likelihood that they're going to cut it another 25, and then some that they're going to cut it another 50. And then if we go out further into June, July, September, October, December meetings, and this is a long way out in the future. This is very forward-looking. But that said, markets price in the expectations of the future. We can see what the market is currently pricing in because these are the odds that investors are basically betting on. So we can see if we look all the way out to the end of December 2026, the expectation is that we're probably going to be somewhere in the 275 to maybe even 350 basis point range. Right in the middle, let's just call it 300. So that is down from the current Fed funds rate of 400 to 425. So if it were right there in the middle and we said, okay, the Fed did drop rates to 300 to 325, we're talking about a 100 basis point drop. So that's 1 percentage point. So instead of 4%, we're talking 3%, 3.25%. Now that's on the Fed funds rate. That's not the actual interest rate. Mortgage rates, like I said, on the other hand, go off of the 10-year Treasury yield. There's going to be generally a margin of anywhere from 1 in some change to 2, sometimes closer to 3% premium on top of the 10-year Treasury yield. Now, if we take a look at the Fed funds rate compared with the 30-year average mortgage rates and the 10-year Treasury yield, you will see, like I said before, there's a much closer correlation between the 10-year Treasury yield and mortgage rates. So red, you have average mortgage rates for 30-year mortgage. Green, you have the 10-year Treasury yield. And you can see these track much more closely than the Fed funds rate. So when you see on the news and the headlines that the Fed's cutting rates and how that's going to impact mortgages, it's important to understand that's not going to directly impact mortgages. And what we can see here, in fact, is that in some cases, the Fed funds rate has come down. So for example, here towards the end of 2024, the Fed began cutting and mortgage rates actually went up. Mortgage rates continued up there. And when we see this contrast, what it's essentially saying in some ways is that the bond market is saying, hey, we don't believe the Fed. We actually think the market's going to do something different than what the Fed's betting on. Or we think the Fed's timing is wrong on this. So just understand that just because there are expected rate cuts does not mean or bake in that there's going to be rate cuts for mortgage rates. Now that said, it could happen. And for example, in this last cut, in these last few months, we've seen rates come down, which has been promising. If the economic data that the Fed is looking at tends to continue in the right direction, and the consensus across the board is unanimous that inflation is down, the market is in a place where if we drop rates, it's not going to unduly stimulate the market and therefore trigger future inflation, then we can continue to see likely the 10-year Treasury yield follow that to some extent. Now, if we come down 100 basis points on the Fed funds rate, that doesn't mean that we're going to see 100 basis points on the 10-year yield either. So that doesn't mean that we're going to see that direct correlation. If we do get a full 100 points drop in the Fed funds rate, it's impossible to say what's going to happen with mortgage rates. But I do think it's possible that we could see in the mid fives if everything goes well, possibly even lower. And on the other hand, the double-edged sword in real estate is always this, is that at the first signs of the actual recession, that's when the Fed usually gets aggressive and they say, you know what, we're going to cut rates. And many times they're very aggressive in doing so. So if we start to see shakiness in the labor market or the economy or macro economy, whether it's national or international things going on, we could start to see the shifting and a quick reaction from the Fed in dropping the Fed funds rate, and then shortly followed thereafter with more conservative investors on the bonds. It's impossible to say where interest rates are going to be in the future, but that should give you some idea as to the expectation and maybe where we might see them coming into 2026. Let's look at housing affordability. And this is from California Association of Realtors historical tracking metric on the percentage of borrowers or likely home buyers that can afford to buy a property. And it's not letting me highlight it here, but San Diego right here, San Diego County, this 26 number right here says 26% of households in Q2 2025 could afford to buy a median priced home based on their median qualifying income. And that's calculating in monthly payment, including taxes and insurance. So as interest rates go up, this number is obviously going to come down. Right now we're at 26%. Previous quarter, 25%. A year ago, it was 21%. So it's come up a little bit. Rates have come down a little bit. Prices in some areas have come down a little bit. Now, if we look at this historical data, we can see here in San Diego County. Now, I think they changed the methodology of this index. In the past, it would have market cycles bottoming around 17%, as low as 12% in San Diego during 2008 timeframe. They're still using the same standard because they're going all the way back to 2000. So we're still looking at apples to apples here. We can see it got down as low as 21% in 2006 cycle. And then even in early 2021 in San Diego, we were as high as 40s, mid 40s, upper 30s. If we see significant drops in interest rates, I think we will see some changes in the housing market for sure, depending on what the underlying reasons are for those cuts. But I think even if there's some economic hardships going on, I think that's going to overall be a benefit to the real estate market as a whole. And then something else I'd like to take a look at is Redfin's tracker on where people are moving to. So in San Diego County, people moving to San Diego, we're picking up a lot of people coming in from Los Angeles, from San Francisco. Look at this, even Raleigh, North Carolina, Washington, D.C. These are all net positive inflows. And granted, this is based on, I think, their search data for people looking at housing in these different areas. But I absolutely believe I believe San Francisco, we're seeing a lot of people come down here from there. And so net migration in San Diego still is positive. It seems places like Los Angeles, it's not the same story. You have much higher outflow than you have inflow. On the short horizon and long horizon, I think San Diego's got a lot of bright future in front of us. The market right now is a little bit chill, and I think there's a lot of opportunities out there for buyers. It's not going to be the most comfortable payment. So there's still a bright future for San Diego real estate. I think we're still in a great position relative to many other California markets. And real estate's always going to be a very local thing. So the market's going to ebb and flow differently in different parts of San Diego than others. There's a lot of opportunities out there right now, a lot more than there have been over the last 3-4 years. It doesn't mean that the prices are cheap but there are motivated sellers. The sellers that are out there are going to be more motivated now than they have been in the past, especially as we go into the winter season. And I think there's opportunities for buyers to negotiate hard, both on the price and concessions, repairs, etc. And I think there's even opportunities for buyers that are doing move-up sales. And I did a video on this a few weeks back about VA assumable loans. So if you're a VA buyer, you could be civilian as well, but mostly going to benefit VA buyers because they can substitute their entitlement. You can go on different databases, we can help you out, and find properties that are being offered with assumable rates as low as 2-3% range. And so you might not have to give up your 3% rate in order to buy a move-up property. Now, it's not going to be perfect. There's not going to be as many options, but there are certainly options out there. And for the first time in many years, I'm looking at the market, I'm looking at some properties, and I'm saying, man, this is actually a decent deal for what they're offering. There's some properties with some land. There's properties with ADUs. There's a lot of things out there right now that if you're of the opinion that interest rates are going to come down and you're going to have an opportunity to refinance in the future, there's some good deals to be had. And if you're looking for any help buying or selling real estate in San Diego or Southwest Riverside counties, give us a call, shoot us a text. Our contact information is below. As always, thanks for watching. I'll see you in the next video.